Good evening and happy Monday. This is the closing bell update for the 15th of May, 2023. In today's update, we will talk about, as always, how the major US indexes performed. We will also take a look at US yields, and we will analyze notable movers to the up and downside. We will also take a look at some macroeconomic topics. We heard some comments from Federal Reserve officials today, including Raphael Bostic from the Atlanta Fed. And we will also take a look at the retail sales number that will be released tomorrow and the manufacturing index, which was released today. The charts of the day will include the bond spread, S&P 500, and the misery index, which is a very interesting index that most of you probably have not heard about yet. And the special topic of today will be the Treasury yield curve. All right, now let's get right to the major US indexes. The S&P 500, we're basically seeing green today across the screen. The S&P 500 finished the trading day up by 0.3% at 4,036.3. The Dow Jones Industrial Average was up by 0.1% at 33,349. And the NASDAQ 100 up around 0.6% at 13,414. All right. Now let's take a look at some of the notable upward movers today. Let us start off by talking about Alibaba Group Holding. The stock finished today's trading day up by 3.43% at 88.27. Now that is basically $37.5 short of its 52-week high, which was at 125.84. Earnings of Alibaba will be reported on the 18th of May. The outlook is very good, expected on earnings per share number of 9.45 yen, which would be a 55% increase from the previous quarter. So expectations for that earnings report are high. Meta Platforms, another notable upward mover today, up by 2.16% to 238.86. Luke Capital upgraded Meta Platforms from neutral to buy today, and they set a price target of $320. And the reason for this upgrade is basically an improving revenue outlook. Now, Shake Shack, another very, very interesting, notable mover today, up by 7.8%. The activist investor Engaged Capital has a 6.6% stake now in Shake Shack, and it is looking for 3 new board seats. Changes would be basically made to boost the stock price. If you look at how the Shake Shack stock developed throughout the year, it is basically trading at half its all-time high in February of 2021, which is basically now down more than 45% since then. And if you compare this to the Shake Shack competitors, they have performed significantly better. So there is a good reason behind Engaged Capital now gaining a 6.6% stake with the goal of actually boosting the stock price. And that brings us to a notable down mover today, a downward mover, which is Oniok. Very, very interesting company. It is basically a natural gas-focused organization. And they have announced the acquisition of the crude oil infrastructure provider Magellan Midstream Partners, according to Reuters. Now, the stock is down today by 9% because the problem that these natural gas-focused organizations have at the moment is obviously they need to cope with rising demand, which is on the one hand a good thing, but on the other hand, there is just this increased need for new infrastructure. So that is definitely putting some downward pressure on the industry as a whole. But there's definitely a great growth potential also here within the acquisition of the crude oil infrastructure provider. So it will be very interesting to see how that stock develops throughout the year. Now let's look at the US Treasury yields today. They're all up. The biggest movement has been in the long duration 30-year yield bond, now at 3.8%. We have seen some movement in the 2-year yield that is now approaching 4% again. It is very, very interesting that we are seeing some steepening of the yield curve here in long duration bonds. I believe the yield curve is too flat, given that the Federal Reserve is still hiking rates, and given the fact that that inflation remains high and the labor market remains tight. So I definitely expect some more steepening at the long end of the curve. But it is definitely interesting to see these upward movements, also because we got some very interesting comments from Federal Reserve officials today. If you're talking about the debt ceiling, if you really look at the very short end of the yield curve, T-bills, for example, they are rising significantly. Yields on T-bills is rising significantly because we are approaching that X date now. So I expect generally higher yields throughout the week until we get a very convincing update on the debt ceiling debate. And that brings me to our macroeconomic topics of today, because we got some very interesting comments from Fed officials. And we will start talking about Neil Kashkari, which you can see here on the right. He is the Federal Reserve President of the Minneapolis Fed. Now, what he basically said today, very, very interesting, just in general. Two of these Fed officials today mentioned the very tight labor market and the fact that inflation is far away from the 2% target, obviously, and they also don't have sufficient evidence that inflation is on a sustainable downward trajectory. Both Raphael Bostic and Neil Kashkari talked about this today. Austin Goodspeed, which you can see here on the bottom right, he's the Chicago Fed president, has been a little more on the dovish side today. But let's start off with Neil Kashkari. He said today that, quote, "We at the Federal Reserve probably have more work to do on our end to try to bring inflation back down. The labor market is still hot, and we have not seen much softening in the labor market. So that tells me that we have a long way to go before we get inflation back down," end of quote. Very, very hawkish comment here from Neil Kashkari, in my opinion. Let's move on to the more dovish side. Austin Goodspeed, Chicago Fed president, said today to CNBC that, quote, "There is still a lot of the impact of the 500 basis points we did in the last year that is still to come. And you add on that there are tight credit conditions, and I think that we should be extra mindful. We need to take that into account, and the only way to do that is to watch it," end of quote. So he's basically reiterating on that data dependence of the Federal Reserve. Now, some more relatively hawkish comments are coming from Raphael Bostic here on the left. He is the president of the Atlanta Fed. He said that, quote, "My baseline case is we won't really be thinking about cutting until well into 2024. If you look at most measures of inflation, they are still 2 times above our target. And so that is a long distance to go. If I had a bias between going up and going down as our next action, I would say we might have to go up. What we have seen is that inflation has been persistently high. Consumers have been really resilient in terms of their spending, and labor markets remain extremely tight. All of those suggest that there is still going to be upward pressure on prices," end of quote. Now, so like I said, two of these Fed officials that have actually talked today have said that the labor market is still way too tight. I keep reiterating the fact that the problem with the labor market is the service sector is the engine of job growth at the moment. And the problem with the service sector is it is insensitive to rate hikes. And that is essentially what happens when you let inflation migrate from a few goods to the service sector as a whole. Inflation becomes sticky, growth becomes sticky. And this tight labor market, in addition to the macroeconomic complications, implications caused by all the liquidity that was pumped into the market during the COVID pandemic. But this tight labor market is really at the root of the resilience of the consumer. So in order to get inflation back to the 2% target, the labor market needs to lose resilience. But like I said, the problem is that all of that job growth is in the service sector, which is insensitive to rate hikes. So the fact that this growth is in the service sector might mean that the Fed has to eventually keep rates at a higher level for longer. And I personally don't expect rate cuts this year. But that also brings us to the next topic. Tomorrow, we will get some more data about the resilience of the consumer. We will get the retail sales report, which will be very, very interesting. Now, an estimate is a 0.7% increase in overall retail sales, which is obviously the month-over-month level. And now this would be an increase following 2 months of declines, according to Reuters. So if the retail sales report comes in right in line with expectations, I'm not sure how markets react to that. Probably some downward pressure on equities, upward pressure on yields. But if it comes in harder than expected, that would just be another signal that the consumer is resilient, that the Fed has more work to do. So it will be that report will be very interesting. Now, we got another report today that showed some economic weakness, the New York Manufacturing Index. This index dropped the most since April 2020, and it dropped to negative 31.8. Nearly 50% of respondents said that business conditions worsened. Now, markets are not, or the Fed in general, I feel like they're not paying that much attention to the manufacturing sector. The manufacturing sector is sensitive to rate hikes, just like the housing sector. So it is a very cyclical sector, and it is obvious that this is a sector that will respond very quickly to interest rate hikes. What the markets will be more focused on is the labor market report, more reports on the resilience of the consumer. So this manufacturing index may be not that important. Of course, it is important in terms of indicating that we are seeing an economic slowdown in some areas, but the retail sales report tomorrow, for example, will be much more important, probably for the Fed and also to markets in general. That is definitely inflation reports, labor market reports, and anything indicating some resilience of the consumer or any consumer-related economic data. Those are the most important data points for markets right now, and markets will be very sensitive to those reports. Now, we have made some progress. It's not really progress, but debt ceiling, about the debt ceiling, Biden said today that he is optimistic that they will actually reach an agreement. We got a completely opposite comment from Kevin McCarthy. He said today that both parties are still, quote, far apart from a deal. Now, I am going to quickly touch upon what a brief default would actually mean for the US economy. What would a brief default mean? I took a picture of this. Now, a brief default would essentially mean that, well, brief default, even like I said, if it gets resolved within days, right? Just a technical default as we approach the X date. This could cost almost 2 million jobs, and I'm quoting Market Watch here. This could almost cost 2 million jobs and send the unemployment rate toward 5%, according to estimates from iCapital. It is obviously the case that the stock market is not positioned for that kind of economic hit, nor for the potential rise in volatility, according to Market Watch. Now, obviously, I'm not sure. There's going to be such an immense, the capital markets are going to be flooded with information if we do get a technical default. So it would be detrimental to markets. It would cause a lot of volatility. It's actually something that I don't want to imagine. Like the Treasury Secretary of the US said, a potential default, even a short technical default, is something that we should not even talk about because it cannot happen. But obviously, I do understand, if you look at the Democratic Party, if you look at the Republican Party, the Republican Party does have a valid point in terms of actually wanting to, because the US has a fiscal spending issue. And it does make sense that the Republicans do want some cuts to that spending. But at the same time, obviously, I understand that things like the Inflation Reduction Act are very important to the Democrats, for example. That is something that Biden mentioned today. The Inflation Reduction Act is something that they really want to hold on to. It is definitely not something that they will let go. So eventually, these two parties will have to meet somewhere in the middle. I do expect some spending cuts, right? Because at the end, the US has a fiscal spending issue that needs to get under control. But there are some investments that the Democrats will definitely not will definitely not consider letting go. So that will be very, very interesting to see how that debate further develops. Now, last but not least, today's special topic is definitely the yield curve. We got some very interesting comments today from BlackRock's Gargipal Chowdhury. She is a market strategist at BlackRock. And she said some very interesting things today on Bloomberg. She said that she would stay away from the long end of the curve because we could see some steepening. So basically, she's saying that we should step out of duration and instead look, like on the chart here, look maybe a little bit more to the middle or to the short end of the curve at the 2 to 6 year sector, because there could be repricing. The markets will probably have to price out some of the rate cuts that they're already pricing in. Now, the problem is, if you look at this yield curve right here, at the moment, we are facing an inverted yield curve where long-term interest rate expectations are higher than short-term interest rate expectations. But the curve has been inverted for a while now. Now, usually the Treasury yield curve, it inverts around 12 months before recession. It inverted, I believe, in November 2022. So that would mean we would technically get a recession in November this year, or definitely by the fourth quarter of this year. But we are still seeing this resilient consumer. We are seeing a very resilient labor market, and the Federal Reserve just keeps on reiterating the fact that they will not cut rates this year. And just in general, if you look at the FOMC outlook, the FOMC expects the unemployment rate to fall to, I believe, 4.5% by the end of this year. Now, Bloomberg has done a great calculation about this. They said that actually, if we do get an unemployment rate of 4.5%, that would mean we would have to the economy would have to lose 200,000 jobs on average, basically starting now per month. So that is, in my opinion, something very unlikely to happen. Now, you need to consider, Jay Powell has said in the previous press conference that according to the FOMC outlook, they are not pricing in rate cuts. The Federal Reserve will not cut rates based on this outlook, meaning that the Federal Reserve expects the unemployment rate to increase to 4.5%. But even in that case, they will not cut rates. So I really don't understand why markets are already pricing in rate cuts as early as June of this year, because inflation remains high, the consumer remains resilient, service sector remains very resilient, which is insensitive to rate hikes. So given that I don't expect rate cuts this year, I definitely believe that the long end of the curve has to steepen again. We will see some increase in yield, and especially the 2025, especially in the 30-year yield. So that is definitely, I totally agree here with BlackRock that the long end of the curve is something we should stay away from at the moment. You should consider duration between 2 and 6 years. But of course, you need to consider that in the 2-year Treasury yield at the very front end of the curve, we are seeing a lot of volatility. So the fixed income definitely has become a very interesting sector, and fixed income is a sector you can profit from a lot of volatility there. But like I said, I totally agree. You need to stay away from the long end of the curve, because I definitely expect some steepening of the yield curve due to the fact that the Fed will simply probably stay hawkish throughout this year. All right, let's get to today's charts of the day. Very, very interesting charts here from the Financial Times. Now, I have reported about triple B bonds. Obviously, yields on triple B bonds have risen significantly, triple B corporate bonds, because Treasury yields have risen as well. But what we haven't seen, we have not seen an increase in spreads, right? Which is an indication that companies are actually not suffering under credit defaults at the moment. Companies that are issuing triple B bonds, which are the riskiest type of bonds. Now, based on this assumption, I've said that we might not be seeing credit tightening to such an extent. But now this chart right here, this beautiful chart from the Financial Times, has kind of changed my opinion about this matter. If you look at this chart, especially here, maybe starting at 2006, right, we have seen a significant increase in U.S. bank tightening lending standards according to the Senior Loan Officer Opinion Survey. Right, you see credit conditions tightening, and U.S. high yield spreads, they're actually starting to rise with a significant delay, because you see it here. Maybe you can see here the net slows response. U.S. bank tightening lending standards are increasing in around 2006, and U.S. high yield spreads are increasing like significant, like a couple of months later, 12 to 13 months later. So that is definitely something you need to consider when you look at the current spreads. And yeah, it's simply something that you need to keep in mind, right? That this slows report, if credit tightening is indicated by the senior loan officer opinion survey, these U.S. high yield spreads will start to rise with a significant delay. Now, another very interesting chart I saw today is right here on the right. You can see the S&P 500 and the certain sectors of the S&P 500 that have actually increased the most, that have outperformed. And if you look, we have S&P 500 growth all the way up here and values all the way down here. Now, this significant spread between growth and value is highly interesting. Growth stocks mostly include tech stocks as well that are part of the NASDAQ 100. Now, why are we seeing this incredible spread? Well, this is my theory. After the events in the banking sector, we have seen yields significantly fall because investors rush to safety. Now, these, especially tech growth stocks, they benefit from falling yields. So that is definitely something that has contributed to this. Another factor that has contributed to the spread between growth and value is the current earnings season, right? Especially the tech companies have reported very good earnings, and that has also led to this outperformance. It will be interesting to see how this will further develop. What this definitely shows is the rally we are seeing right now, the upward movements we're seeing in the S&P 500. We are seeing a risky rally because a rally that is very narrow simply usually is not a sustainable rally. So it will be very interesting to see how long growth stocks can keep up this outperformance and how long they can continue to kind of support the overall US indices. And last but not least, this is the last chart we will take a look at today. It is the, I call it the misery index. It is basically this graph, it combines the unemployment rate and it combines CPI, so the consumer price index for all urban consumers. Now, let us go back to 1990, right? What you can see in every recession here, recessions are indicated by by this gray area here. We can see that during the I believe this is like 1991, between 1990 and 1992, during the recession, the unemployment rate plus consumer price index, this misery index, increased to above 12.5. So it seems like this here is indeed an exception. But if you look at the other recessions as well, I shortened this graph here, but if you extend this graph to all the way back to 1940, you can see that this misery index, it increases to a high value during those recessions, especially right here during the COVID pandemic, obviously. What we're seeing here, this index, this combined unemployment plus consumer price index, this index is pretty low. It is as low as right here, 2021, and then it dropped below that for a while. So it is slightly elevated compared to other periods in history, but it is far away from recessionary levels. So this is just another signal that the consumer remains resilient. The underlying economic data continues to show a resilient economy. And it is still, even based on this measure, it is still very questionable to me why markets are already pricing in rate cuts this year. But essentially, I'm just as data dependent as everybody else. Essentially, it just comes down to the economic data being released, starting off with tomorrow's retail sales report, which I will, of course, also analyze. All right, I think that is it for today's closing bell update. I hope you enjoyed today's episode. And another closing bell update will be released tomorrow. Have a great evening.